This is the first in a series of video analysis that take a look at precious metals and their stocks. The gold price has recently taken quite a battering, with the price having fallen from a 2016 high of $1378 to last close of $1171, which is not far from its low for 2016 of $1071, so early on in the year, which is perking my interest on whether it could now be time to accumulate some more of the golden precious metal that mankind has been obsessed with ever since we sought out that gold and silver shimmering signs of water on the horizon on the sun-baked, parched East African savanna, as has been imprinted in our DNA. Firstly, gold and silver have never really played a major part of my investment portfolio, usually amounting to less than 4%, so not something that I look at often, usually only when I observe that the price could be cheap for accumulation or expensive for distribution purposes. Also, I don't trade gold or silver often either. The last time I traded gold was over a year ago, so I'm definitely no gold bug who tend to perceive the hand of hidden forces at work in every minor price movement. Rather, my objective is pretty simple, which is to buy gold and silver when cheap and sell when expensive, whilst in between I don't tend to pay much attention to either. So the purpose of this relatively brief analysis is to answer the question, should I buy gold bullion today, soon, or leave it for even lower prices? In terms of perking my interest in investing in gold bullion today, I would be seeking a potential reward of at least 20% over the next 12 months for running the risk of buying gold at or near current prices, i.e. for gold to hit at least $1,400 within the next 12 months, which would be a multi-year high. Whilst for the more volatile gold stocks and silver price, I would be seeking a potential reward of at least 30%, so unless I see those sort of risk rewards, I'm unlikely to commit to investing, especially as the gold price and presumably gold stocks are currently in a downtrend, so implies lower prices are more likely than higher prices, which is fine for investment purposes where the name of the game is not trying to catch the bottom, but rather the potential reward at the target exit price. So prime consideration is, can I see gold bullion achieve a minimum profit potential target during 2017 or not? Whilst I will take a look at silver, gold stocks such as the HUI index and GDX ETF in a separate analysis. Looking at the 2-year chart, clearly the gold price is in a significant downtrend triggered off the break below 1200. Next stop is probably around 1075 and then 1045, which implies downside is relatively limited, i.e. at worst another $100 drop or about 9%, whilst resistance is clearly at just below $1,400 to $1375. So current risk versus reward is about 17% reward against a 9% risk, which is not particularly appealing. What if gold price fell to $1,100? That would be a potential reward of 25% versus risk of only 3%. Now that would be appealing. So it's probably worth keeping a close eye on gold, perhaps even a limit order to buy bullion at or below $11.25 for a potential 22% return against a 5% risk. So does the 5-year chart back up what the 2-year chart is saying? Well, it backs up everything the 2-year chart is saying and further confirms that $1,400 is a strong resistance level which, if overcome, could propel the gold price much higher, and the chart implies that a break higher would be more probable than a break lower. So whilst we can't let ourselves get carried away by anticipating a break above $1,400 and fantasize, for instance, about gold hitting $1,800, which would represent a 63% gain on $1,100, nevertheless the risk reward is better on the long-term chart than the 2-year chart, which acts to confirm that $1,100 to $1,125 are relatively good levels to accumulate gold at given the risk reward profiles. And ensure you are subscribed for my next analysis in this precious metals series as I will look at silver bullion and the Huey index and GDX ETF.